Similarities and differences between I bonds and Treasury inflation-protected securities. Tips. Pretty good article my man Mike had sent to me here. Just came out yesterday from MarketWatch. So good stuff. We're going to read this because I think it's important. Look, man, at the end of the day, someone had said, I thought you were a deflationist, and now you're going to buy Treasury tips, essentially. I am. I do fall in the deflationary camp, 100%. But I do know two things. Deflation is wonderful for bonds. That is a fact. So bonds do great in deflation. That's just basic mathematics. Fixed income, let's just draw this. Fixed income means you're getting 3% a year, whatever your coupon is, 3% a year on your coupon, and the cost of goods is going down. So fixed income, you got a increasing, what's that called? The delta, the difference between. That's how fixed income works. And so it's fixed. And deflationary things, your dollar buy more. But trust me, deflation is not a good thing. Just people say, I can buy more with a dollar. Yeah, well, that's not good in the overall context of an economic growth because there isn't any. Fixed income in an inflationary thing means the cost of goods goes up. And your income is fixed. It's fixed income. So inflation is bad for fixed income. I don't think anyone would disagree with that. Now, what happens in deflation is because your income is fixed, the coupon that you're getting is fixed as well. So that's a benefit. However, if it's an inflation-adjusted portfolio, you're not going to make any because it's deflationary, if that makes sense. So your fixed income, you're not getting a coupon because you don't get a coupon. It's based on what the inflation rate is. So the inflation rate is 0, you're not making any money. The only thing that's happening is the dollar is dropping, but your principal is gaining. Does that make sense? So any kind of bonds gain principal relative to deflation. All right, so even though it's not a fixed income, there's no income, your principal is fixed. And when the bond matures, you get everything you put back in. That's the benefit of a bond, is a deflationary thing. That's why I like bonds. On the other hand, if I'm wrong, well, it could be. No one knows. Inflationary protected bonds make sense because it has an adjustment based on inflation. And so that's what I want to talk about here today because there's two types of inflationary adjusted bonds. Whoa, hold on a second. Hi, buddy. I bonds and tips. So both I bonds and tips are bonds offered by the government, the safest security there is out there. As such, they both have low default risk. All right, both I bonds and tips have a fixed interest rate that is set at the time the bonds are issued. Each adjusts the amount you earn based on inflation. The price adjustment is based on the CPI. All right, however, the method for making the inflation adjustment is different for each. So this is interesting. I bonds accrue interest over 30 years or until they are redeemed. So you'll make something over 30 years or until they're redeemed. Interest is paid every 6 months in I bonds. There's an inflation component to that interest rate that is adjusted, so the total interest payment is the fixed rate plus the inflation adjustment. So if there's no inflation adjustment, you'll just get the fixed rate and your principal back. If it's deflation, the principal will be worth more than it was when you invested in it because of the value of the monetary supply went down. Tips are offered differently with 5, 10, and 30-year terms. They also have a base interest rate that is fixed over the life of the bonds. With tips, the principal is adjusted to inflation monthly. Interest calculations are then based on the adjusted principal. You can hold both I bonds and tips for the full term until maturity. If you don't want to hold the bond until maturity, there are options to sell are different. I bonds must be redeemed through the Treasury Direct. They cannot be sold on the secondary market. You cannot redeem your I bond for 1 year after its purchase, and you lose 3 months of interest if you do. I bonds function like CDs, 100%. You can buy and sell tips through the secondary market in any way, in any time. In this way, they function more like other bonds. Both I bonds and tips are subject to federal taxation, but they are exempt from state and local tax. I bonds do have a few advantages over tips. You can defer paying federal taxes on I bonds until the bond is redeemed or it reaches full maturity. Alternatively, you could elect to pay interest annually. In addition, I bonds may be exempt from federal income tax if they are used to pay for higher education. Well, that's pretty good. Tips are taxed differently. You owe federal income tax on interest payments and inflation adjustments annually, even if you don't sell the bond or receive any income, because the gains may occur in an upward adjustment for the principal. All right, so what we're saying is here, you want to hold tips in tax advantage accounts, IRA, and that's where the bulk of my portfolio is, IRAs. Tips are good in tax advantage account, tax deferred accounts. I bonds can be held in brokerage accounts. Interesting. All right, so let's keep going. This is a good article, man. Several features of tips make them preferable in certain situations. It's convenience, 100%. So you can go in the market right now. You can buy a portfolio of tips, hundreds of thousands of dollars of Vanguard tips. There's unlimited purchase of tips, and they trade on the secondary market. So a huge advantage. iBond's not like that. So let's go to the iBonds right here. You're limited purchasing $10,000 per person per year in iBonds through Treasury Direct. That's it. You could buy up to an additional $5,000 per year if you buy paper. iBonds are, if you want to slowly build a position in inflation bonds, iBonds is a reasonable option. But if you want to reallocate a portion of your relatively large portfolio, you can't do that in iBonds. Price appreciation. When interest rates decrease, the value of most bonds increase. This is because we already know that. There's no secondary market for iBonds. Selling them means redeeming them for the face value. So therefore, iBonds offer no potential upside for price appreciation, which in this case, no one's really worried about because no one's really expecting interest rates to go down. All right, so pretty good. Advantage to iBonds. The drawback about iBonds is that you can't buy them in the secondary market. The other drawback is you're only buying $10,000 per thing. iBonds cannot go below zero. Interest rates cannot go below zero, which is good. Tips can, and they are right now. Tips have a negative interest rate. It doesn't matter, man. At the end of the day, you're still going to get your matured, your par value plus whatever you've gained because of inflation or whatever the fixed interest rate is. Right now, it's nothing. But at the end of the day, at least you know you're getting your money back as long as you hold them to maturity, which is a big, big deal. So I thought it was a pretty good article. I'd like for you to read that. If you have, like me, iBonds aren't going to do the trick. I mean, look, you should still buy some, don't get me wrong, but they're really not going to do the trick when it comes to your ability to reallocate a portion of your portfolio. Secondly, let Pablo. Okay, don't get caught up. And I don't believe in inflation. I do, but it doesn't matter. Bonds, in this case, inflation-adjusted bonds are good for inflation. Any fixed income is good for deflation as well. So just don't get caught up in that, because if you were worried about the market, you're worried about inflation, and you're worried about the stock market, inflation-adjusted bonds are great. If you're worried about deflation, fixed income is great, regardless of what kind it is. And I hope this makes sense. Love to hear your comments. Thanks for sending me the article, Mike. See ya.